Good afternoon, everyone. I'd like to officially convene today's CFPB Community Bank Advisory Council, or CBAC meeting. I'd like to welcome CBAC members as well as members of the public. My name is Kim George. I serve as the Outreach and Engagement Associate for the CBAC here at the CFPB. Today, I'll be serving as the designated federal officer for this council meeting. As background, the CFPB established its advisory committees to provide information, analysis, operational expertise, knowledge of their communities, and feedback to inform the Bureau's work. You can find a full list of the advisory committees on our website at consumerfinance.gov. As a reminder, the views of the CBAC members are their views. They are greatly appreciated and welcomed, yet they do not represent the views of the CFPB. Today's meeting will run from 1 o'clock and conclude at approximately 3 o'clock p.m. Eastern Time, with 2 session topics, one being credit card competition and 2 trends and themes in community banking. Members at the table today and Bureau staff, if you would like to make a comment, please use the microphone located in front of you. Please remember to turn the microphone on when speaking and off when you concluded your comment. When speaking for the first time, please provide your name and organization. I am now pleased to pass this over to Director Chopra. The floor is yours.
Okay, great, Kim. It's great to have all of you here in person. This is, I think, our first meeting in 4 years that we've had. So I appreciate all of you being here in person with us. I hope that we can continue to do this. I know I saw some of you yesterday at the event with all of you. Let me just make a couple of opening comments because I think we want to spend most of the time in the discussion. I think that there has been a lot of places where we have seen community banks really in some ways share has moved from community banks on key product areas to other places in the financial system. So I think starting many years ago, there was, of course, an increasing shift to mortgage lenders, bigger ones, and often non-bank. That is really where it moved outside of the banking system in some ways. There's been other places like auto lending where we have seen it move in different directions. I think we at the CFPB have been thinking a lot about where the places where it's leaving the banking system or where it is going to only the largest. So we've been undertaking an effort across many of our product areas to think through that, including the implications of some of that going away. So in the case of auto, for example, the extent to which that it is more concentrated or less competitive, it also leads that an individual may not have a relationship with the entity that's actually collecting payments from them. Or when it comes to distress or repossession, there's often not a dialogue between the consumer and the place they have a relationship with. So obviously, I've talked to you before about digitization, future of relationship banking. I think today we wanted to talk about a couple of topics. As Kim mentioned, we really want to talk quite a bit about credit cards. So we now have a situation where credit card outstandings have once again, we've seen an acceleration in that. We've seen real shifts in how credit card customers are selecting their credit card issuer, where more of the competitive forces are shifting toward rewards as opposed to some of the other features. There's obviously been more things in the news about very large credit card mergers that are pending, including the pending Capital One Discover one, but also a host of other issues, including how smaller financial institutions will or will not be able to compete with larger ones. So we're also going to be able to gain some insights into really how are smaller community banks offering credit card or similar types of products, open-end lines of credit tied to bank accounts, and be able to understand really how many of you in the industry are thinking about this product overall. I think we're also going to spend in our second session a little bit about some trends in community banking, including really some of the statistics data we're seeing in the higher interest rate environment. So, I really, again, want to thank all of you for doing this. We have some of our CFPB colleagues who are here who are going to talk a little bit about what we are doing, ask you all some questions. But again, I want to thank all of you for being here, and especially to Kim and all of her colleagues who have to do a lot to put all of these together and comply with all the laws we have to comply with. So thank you again. Can I turn it over to Carlos now, or turn it over to you?
Thank you, Director. Appreciate your remark. I am Carlos Naudon. I'm the President and CEO of Ponce Bank, and I have the privilege of serving as the chair of this committee. My apologies, I did not have the mic on. So let me just repeat, I'm Carlos Naudon. I'm the President and CEO of Ponce Bank, and I have the privilege of being the chair of the CBAC. We're pleased to be here today with all of you. I'd like to echo your comments, Director. I thought they were very insightful. Some of us here have been in banking for 30 and 40 years, and we have seen the erosion of community banking from the point of view. At one time, we were the largest ATM network. Today, non-banks dominate the ATMs. If you look at all of the other pieces, home mortgages, you mentioned, that's the case. We are concerned that the payment system is also being eroded away from banks. So we will have a discussion on credit cards, which is another part that we are concerned about in terms of the community banks. But as I mentioned, we're joined here by other members of the CFPBs, the advisory board, where joining me today are Derek Henderson from DR Bank, Bruce Hoyer from Belt Valley Bank, Jennifer Johnson from Forte Bank, Sergio Ora from Citizens Savings Bank, and Victor Ramirez from Beneficial State Bank, and Ignacio Urrabaso from Commerce Bank. So why don't we shift a little bit in terms of our discussion on credit card. We're joined today by CFPB's subject matter expert, Danny Martinez. He's a program manager in the Office of Markets. Again, as a reminder, don't do what I just did and press the mic button if you want to discuss. So,
Can I ask who's on the, so Bruce is on the WebEx, who else is?
Yes, Director. Bruce Hoyer is our CBAC member. He
Yeah.
is attending virtually, and Manny
Okay, great.
from ABC.
Okay, all right.
okay, so one of the questions is how do we compete against the larger banks that have the credit card marketplace? I will tell you that we no longer offer credit cards. We were driven out of the market because of the competition, because of our inability to grow the portfolio. And it was very difficult to match on a cost basis, even though large credit cards holders have very significant interest rate. That was not sufficient for us, given the kind of losses that you incur. We are an MDI and a CDFI, and our communities are very low income. And so they would struggle with paying on the credit cards. So consequently, we had to get out of the business because we couldn't offer the same rate and be competitive. So we had to offer a lower rate, and which meant that they didn't have enough to cover the losses. So welcome comments.
Yeah, and I don't know, Daniel, if you want to just share overall some trends about what we have seen in the structure of the credit card market, also just to lay the table for everyone as well.
Yeah, absolutely. One of the stats that comes to mind, I think, is in 1994, the top 10 banks had about 56% of the share. Today, they have 80% of the share. So we do see that perhaps it becomes increasingly difficult to compete with the largest banks. And so from my perspective, would love to learn from you in terms of if you do offer cards, how do you compete? And if you do not offer cards, what would have to change in the marketplace so that it makes it a viable position to offer a credit card in the market?
Well, like I said, Daniel, we no longer offer it, but we have looked at and participated with the fintech offering essentially a virtual card that was more of a secured revolver than a typical credit card. But there, again, much lower cost to entry into that market. But all kinds of compliance issues and all kinds of fraud issues got in the way of that program. But it showed that you could compete with the right product against the credit card side of the house, especially for folks that did not have decent FICO scores. And so, but you end up with a subprime portfolio too, which has all kinds of other implications.
This is Derek Henderson, TR Bank. Just to echo Carlos, we also do not offer credit cards directly, but are engaging with potential fintech partners to be able to offer them. We feel that is the only way that we could enter the market at this stage.
And can I ask just generally, without revealing too much, do you feel that there are a lot of options you have in terms of partnerships? Is it typically going to be ones where they administer the program, but then simply the receivables will be on your balance sheet? Kind of what is it mostly to market to your own customers that is an option for them?
It's mostly to market to customers that we don't have or could not have in our market area. So it's a way of expanding what our current market share is in our immediate footprint. In terms of the setup, that's a common setup in terms of who's performing what task. But there are a lot of different options out there, and not many that might meet our standard for due diligence. And that's another common issue, is finding something that we are willing to work with and can trust to perform that direct consumer interaction.
And may I ask a follow-up question? What do the fintechs offer? Like, what type of capabilities do they offer that you're looking at?
Like mentioned before, rewards is kind of the big thing they try to push, or discounts on various types of streaming services, for example, or insurance type products for your cell phone if you pay it through that product. Those types of perks is how they try to differentiate themselves the most.
Yeah, this is Sergio Ora from Citizen Savings Bank. Like Derek and Carlos, we used to offer credit cards. We have sold our portfolio to the third-party service provider that we are now using. So we're basically called the agent bank for that. Part of the issue that we had was we couldn't, the size of our bank did not allow us to have the capability to offer the depth and breadth of services of the different product types on the credit cards. And so we decided to exit holding the portfolio. We still offer the credit cards to our customers more like a service now, as opposed to an actual issuer, because we, in the portfolio, the balances are no longer ours. And we do get, in a sense, a fee for the referral to our service provider. However, we are also, because of the markets that we serve and the customers that we serve, part of our current evaluation is to provide what we call a secured credit card primarily for the customers and clients that have the lower credit profile than the norm. And I think that's, although we have not done that yet, again, being an MDI and CDFI and all the other things that we do from being a mission-driven institution, we want to try to find the right mix of products that in fact can be focused on the people that would not have access to the product before because they wouldn't qualify from a risk profile standpoint. So that's our goal, to provide financial products and services to people, businesses, and communities that would not really have access to them previously. And if we can do that and still, in a sense, maybe not even make so much money as, or profit from it, but be able to expand our capabilities to serve, that in a sense fulfills our mission. And so that, that's where we're going.
So you're still doing the secured card or you're?
No, not yet.
Not
Not
yet.
yet.
Oh, but you're looking
We're
at
looking
that.
at-
I
yes,
see. And let me ask you, how do you think of that versus, what, let me go back. When did you get out of it?
We got out of it last year, actually, being a card issuer and a holder.
Mm-hmm.
And again, efficiency, productivity, we just didn't have the scale to do that properly. And what others have said, the risk management practices that would really be appropriate to have, we didn't have the resources internally to do that. And so we felt that we wanted to still offer the product, but offer it in partnership with a third party. And so far, it's been working out pretty well. And frankly, we have in our partnership, we have established an agreement relative to the profile of the customer that we have that would be applying, and that has worked out so far pretty well.
We have, my name is Ignacio Provaso, and I'm President and CEO of Commerce Bank in Laredo, Texas. And we have something similar to Sergio. I think we have, about 15, 20 years ago, we sold that portfolio also that we had direct lending through a credit card, our own internal credit card. But I'm sure, as you all will know, the credit card business is a business of economies of scale. You got to have a very, very large portfolio to observe, to take all the losses that will be incurred in this type of portfolio. And we just couldn't, afford to take those losses, not with the rate of return that we were expecting. So we sold that portfolio a long time ago, 15, 20 years ago. So now we're under, we've had two banks that have done the servicing as agents. We're the agent, and we do a referral and we get a referral fee for it. And it's working fine. Our customers are happy with them, and it goes back to the rewards issue. They like the rewards, and they like to see something in return. They do have, we have an unsecured, well, it's not unsecured. We do have a card that is outside, it's gone through that particular bank, the third-party bank, but it's done to the Mexican nationals because they will not take Mexican nationals. So we secure that particular loan with a particular CD that's inside the bank. In other words, the Mexican national will put up a CD, let's say for $5,000 or $10,000, and the credit card company will issue them a card with our guarantee, with us holding the CD as collateral. So it helps them because the Mexican citizens that travel into the United States need a U.S. credit card. The Mexican credit cards don't work over here very well, so they need a U.S. card. But we lost that business, a long time ago because economies of scale, and all of us are community banks. We just can't compete with the rate nor the losses you can incur, and the servicing and the monitoring and that kind of stuff that goes with it. Just like we lost the automobile industry. We lost that automobile industry 30 years ago to the Ford Motor Credit Company and GMAC and all those. We can't compete with them anymore. Not in rate and not in flexibility because you can get a loan immediately at the car dealership within 15 minutes and you walk off and drive away. So we can't compete. So we've been cornered into commercial lending, basically, and basically commercial real estate lending. That's where we are, and I think that's where most of the community banks are. And if we don't find some alternatives to compete with the credit cards, the credit cards, I'm telling you, there are the ones that I see that are our customers that we do a referral. I think about 85% of the loan of those applications are approved by that, which is not bad. I don't think we could have that kind of approval rates through our bank and through our underwriting criteria as our consumer loans would be. They have a more liberal lending policy than we do. And the reason for that, I go back to the economies of scale. They can take those losses and it wouldn't matter to them because they're all $5,000, $3,000, $7,000, limits. So they can take that. But, so our customers are happy because they wouldn't qualify under us and they got a credit card with our name on it. So it's a win-win situation.
And then are the compensation, and we know some of this, and Dan can raise this as well. Some of the compensation models, all of the credit risk is not with the referring bank. It is with the actual, let's call it issuing bank.
Yeah.
Typically, the structure is almost like a affiliate fee, where it's really at origination, at application and approval. And then there's really not that much financial participation beyond that.
That's correct.
In certain circumstances, though, we wonder whether community bank balance sheets would want to be deployed to some degree of that consumer lending. And Ignacio, maybe I'm not pushing back, but I think the argument that you really need scale, I think is probably true on some dimensions when it comes to IT and tech. There's probably dimensions of the servicing that require some scale. But I think the issue of scale you're raising is that how big your credit box is. The more that you go into lower credit tiers, that's where the diversification of the portfolio is going to matter. And I think we hear that. We just know that in other types of lending arrangements, we would hope to think of ways in which the customer can also, you all can benefit from taking the targeted credit risk, making money from it while also helping to compete down on rate. Because, and Dan, you should jump in here. Our finding is that the more concentrated the industry has become, the rate competition has become in some ways less intense. And we now see, why don't you share, Dan, the huge spread, the increases in rates we're seeing even when controlling for credit tiers and even when controlling for changes in the Fed funds rate has been pretty startling to us. But
let me say something
Yeah.
going to your point, though. I do think you're correct, probably. If you would segmentate that market that we are in, and I'm in Laredo, Texas, it's 97% Hispanic. And if we done some analysis and the credit scores in our community are below normal. They're not your 650 or 700. They're below normal. And for us to segmentate that market and say, okay, I'm going to get into this business and take, let's say, a better segment and say, okay, I'm going to take the mortgage business type, the 675 or even the 700 and above. I think I'm going to get into trouble with fair lending.
So I think we can have a conversation offline on that. I mean, you are able to really set criteria and pricing. And I'm happy to talk more of this. I do think, though, that their existing law does allow you to, as long as you're not really treating people differently because of that, and that you have real data to suggest where there would be credit performance differences. But I'm glad you raised it because it's something we should all be thinking about, how to make sure that that's not an impediment for you. But go ahead, Dan, why don't you fill us in on?
Yeah, absolutely. We did an analysis recently looking at APRs on credit cards, looking back the last 10 years, and we found that the average APR 10 years ago was 13%. As of the end of last year, it was 23%. And that was a 10% jump. But only half of that was increases in the prime rate. The other half was increasing APR margin by the issuers. That's a substantial increase at a time when the market has been concentrated, I think, with the largest banks at the same time. And so there are many things that the gives us pause and concern and questions about the market in terms of what that means for consumers and how banks are competing, and particularly with rates. Which I think brings me to a question that I think that I have, and this agent relationship that you have, do you have the ability or to influence the rate that is offered to consumers, or is that set by the partner?
That's,
Okay.
that's that partner. Now, just a question, Daniel, on, recognize the rapid increase in the rates, the APRs. How, does your study also show any kind of movement in terms of the average credit profile? Has it, has the rate gone up and the average credit profile remained the same, or has commensurate, I'm thinking risk-based pricing?
Absolutely.
Has the risk profile on the average gone down? Or what did you find?
Yeah, that's a great question. I'll answer that maybe in three pieces. We did disaggregate by different FICO bands, FICO tiers, and the increase is observed across all of them, from the people with the greatest credit to the people with the lowest credit. Credit access has increased during those 10 years for all segments, including subprime population. So more people with subprime scores, as well as more people with prime scores, have a credit card today than they did in the past. But the proportion of all balances that are subprime, just as an example, that still remains relatively the same as it was 10 years ago. But that is an excellent question. I think that it's always an important aspect about this.
That's an important point, because again, who we are, what we do, and I don't really like to call it subprime, but that's a characterization of the credit profile. And I will look at it from the standpoint, although we're talking about credit cards, I'll move a little bit into the payday lenders. What we'd like to do as part of our vision in terms of fulfilling our mission is to create that alternative for the individual in the communities we serve versus the payday lenders. So to that point, if we are able, with whatever credit product we can offer, that I don't remember what the payday lender's average APR will be. But so to the point that we said, we can't make money on that. But if we're able to manage the risk, and instead of saying 40% interest rate APR that the payday lenders would have, charge 23% and manage the risk, we could make money in that. And I think that's really the key part. We need to be thinking about how we serve our communities and the constituents in that community by offering credit, but still doing it safely and profitably.
Well, this is part of why we wanted to have that discussion, is because there has been attempts over the years to try and figure out ways that, let's call it, smaller dollar lending can occur at cheaper rates. And you mentioned payday, which on average has very, very high APRs. So over the years, there's been efforts by the bank regulators that I think have been pretty unsuccessful in stimulating installment lending, where there would be an installment loan of $300, $500, whatever it may be, repaid in installments. And it is clear that that has not really been a scalable enterprise. The fixed costs of that and the cost to deliver, collect, just the numbers don't work. So really, I think we've had a view here that it's probably revolving credit that is probably more likely to be scalable than non-revolving credit. And one of the safest types of revolving credit that exists is a credit card, because it's pretty well established what the norms are, and it's very much in the banking system. So this is why we've been trying to assess what is the ways to get more of that revolving credit in the banks. Now, I will say this, maybe it's not a credit card, but you certainly see a lot of smaller banks being able to offer lines of credit attached to their deposit accounts using the debit card. So the debit card could be the access device for which an underwritten line of credit is offered with a maximum. As you mentioned, charging, and I don't know what you mentioned, 27, 28%. That's still way cheaper than is what available elsewhere. So we're trying to think, what are the ways to provide that kind of competitive pressure that will also allow smaller institutions to make money? Because it can't just simply be that there's 8 choices, 7 choices. Because when you only have 7, 8 choices, then you're not going to have the same type of price competition. And actually, as Dan mentioned, there is a big difference when it comes to pricing on credit cards. When you're shopping for a mortgage or shopping for an auto loan, typically you're quite focused on the monthly payment. And in fact, we know that that causes some other issues, including in auto lending, where it's such a long duration of loan, but they're pricing on the monthly payment. In credit cards, it seems that because there's no context of a monthly payment, it's an open-end line of credit. The way the marketing has shifted is way more toward other features, including, the discounts, as Derek mentioned, on your streaming. I think you see a lot of credit cards trying to give special perks for recurring monthly payments because they're trying to encourage credit card stickiness. And it's also a way for a consumer to materially see some economic benefits, because when they sign up for the credit card, they're actually not revolving at that time. Unless they're transferring a balance, they're starting with no balance. So it is a tough way for a consumer to think about what should they value the most. So I think that is a little bit, we're seeing concentration, lack of price competition, and in some ways some difficulties in how you market to consumers. But I think I interrupted you.
No, it's quite right. What you're talking about, we have tried and we came out with a product that's exactly that. Line of credit, like an overdraft line of credit attached to a checking account, where you can actually maintain a balance of the checking account without going down to zero to draw the line. The problem we run into is that we use the standard underwriting criteria, you go down to the FICO scores, and most of them fail. And so we switched it into a cash flow model where we can get access to their checking account balances, and we can determine what they can pay. That's been literally, we're in the first few months of offering that, and it looks promising. The pilot we have done looks good.
Yeah, I think that's going to end up being a major opportunity, is the shift to cash flow underwriting. Because if we do look purely at just, there's going to be different subsegments, but for those who are salaried or not salaried, wage earners, that they're earning, and you're seeing the direct deposits.
It's predictable.
It provides a lot of predictability in terms of underwriting in ways that I think for those of you who serve populations, many of whom may not have long credit histories, either because they're young or recently moved to the country, that's very, very valuable. And we're seeing that across the board.
I could share a little bit from a different perspective. I'm Victor Ramirez with Beneficial State Bank, where I guess in our discussion, I'm one of the unique banks because we do offer a credit card. We are a bank and a CDFI. And I also want to provide another perspective on my flight over here on American Airlines. I mean, they were really heavily promoting their American Airlines partnership with Barclay Bank. And I know their interest rate is pretty high. It's double digit. But really what our consumers looking at is the benefits. Are you going to get early seating? Are you going to get your baggage fees waived? And other benefits too. And so that's one of the things that I think consumers are looking at, balancing the lower interest rates versus some of the benefits that they're getting. But from our perspective, I want to share a little bit about our portfolio. I got the latest performance from our credit card division. We have our new accounts have actually remained flat when we compared our first quarter 2023 to 2024. It's remained basically flat, although.
Do you mind sharing how much outstanding there is currently?
Oh, I don't have that at.
No, it's okay. It's okay.
Sure, sure. We haven't seen that the balances have increased about 30%, and delinquencies also increased about 15%. Our portfolio makes up about, is it 60% consumer and 40% business. We are limited right now in only promoting it within our footprint, which is California, Washington, and Oregon, and it's primarily because our limitation on our core processor. But we're transitioning in August, and so we should be able to increase our footprint even at national scale. So that is part of our business model to expand our credit card portfolio. We also have a rewards program, which is probably our best performing and most popular credit card. It's called Climate Card, and it aligns with our mission. Our mission, we're very mission oriented and mission focused around environmental justice, social justice, racial justice, economic justice. And so this is very popular with a lot of our consumers who are interested in investing and doing business with a like-minded institution. And so we provide, for every point is given for every dollar is spent on this climate card, and that those rewards can be invested back into a nonprofit of their choice, and can be given to a nonprofit that it's also environmentally focused, or a nonprofit of their choice. We don't have those numbers yet to try to see where the dollars are being invested into, because we're using a third-party vendor just for that rewards program. But again, with this new transition into our separate core and more advanced core, we should be able to have that data very soon. It is the climate card is very popular with more the credit savvy consumer, and we notice that they usually don't carry many balances, and the delinquency rate is also pretty low. We also have a secured credit card, and it's part of our community program, and that we're actually partnering with some nonprofits where we provide some financial education. And there's one in particular in the Bay Area called CROP. They're an organization that helps support individuals who are recently released from prison, so formerly incarcerated. And so we're helping establish their credit. Many of them don't have any credit, and so helping them build their credit through the secured credit card. So we provide the financial education piece on that. And so far to date with that nonprofit, we have about 300 secure cards, and we're very low delinquency rates.
Terrific. Go ahead, Ignacio.
I was going to say, going back to what Carlos was talking about, well, we do have in Laredo, Texas, an organization called NeighborWork, which is a CDFI, and the bank has, allocated some capital into that CDFI for lending. It's called a small loan lending program that they have, and basically it works where the NeighborWorks engages with, let's say, the county of Laredo, and they will get all their employees, and anybody who's been an employee of the Webb County organization there for over a year will qualify for $1,000 or $2,000. I think it's $2,000. And they don't have to touch anything except go to their computer and get online, and they will be able to get $1,000 directly into their account. And then the county will automatically, the payroll department, HR, will then deduct the payment from them and pay them, the monthly payment. And they do this, and it's been very successful. The problem is that the yield on them is 12, 13, 14%. It's not that much, but nobody touches that. It's all automated, and it's a software that's been developed in South Texas, in McAllen, actually. And the problem with that is that the employers, the large employers, are skeptical about it. They just don't want to get involved in that because they feel that there's something wrong with it. Especially with somebody like NeighborWorks, so they really don't know what they do. It's a housing type of organization. But they go to the city of Laredo or the school districts. The school districts will not touch you at all. But the whole point of here is to safeguard them from going to the payday lenders. You know, right around my bank, there are probably 15 payday lenders around me. And those are all prime land that they are able to buy. And you wonder how in the world they bought that prime land, that prime corner, and they do so well. And I know why, but you know, they're thriving. They're doing very, very well. So NeighborWorks, through this organization that we capitalize it, I'm talking about the bank, for CRA credit, they're trying to take away that market from the payday lenders. But it works, except that the employers are reluctant to do that.
Was there anyone else? Yeah, go ahead, Jen.
Jennifer Johnson from Forte Bank. Like my colleagues, with the exception of Victor, we no longer offer credit cards in-house. We don't have a portfolio, but we do partner with a third party, not a fintech, a banker's bank, basically. We don't have any control over pricing, over the rewards programs. We offer it strictly as a service to our customers. And I would go as far to say as a lot of the consumer lending we're doing in-house also we're offering as a service to consumers, not as an income generator and not as a growth opportunity. You talked about scale earlier, and you mentioned the scale in terms of management and servicing. Definitely, that's a challenge. But the numbers, again, just don't work for us to consider expansion in that area. There's no, even if we tried to be competitive, the leap is so massive for us the volume we would have to do to be profitable doing that is so excessive that it's prohibitive from us from continuing in that area. You mentioned installment loans, small dollar installment loans versus revolving credit. I would actually disagree with you that revolving credit would be easier to offer consumers because the disclosure requirements, the underwriting requirements, the servicing requirements are far more significant than they are within an installment loan. Our institution offers small dollar installment loans, but we don't offer revolving lines of credit unless they're a HELOC, unless they're tied to a mortgage. The only expansion we're trying to do to that and NeighborWorks is a great example because we've partnered with a religious organization in our area to offer a small dollar installment loan that the institution guarantees. It's that guarantee that takes the risk out of it for us so we can offer these $500 loans at 7%, to somebody, so they're not going to a payday lender, so they're not going to a title lender. But we need that support because otherwise, as a community bank, we can't avoid the losses and the cost. We don't even break even on auto loans right now. So the cost is so significant for us at the volume we're doing that partnership is essential for us to move forward. We do it because we want to service our existing customer base, but it's not a growth opportunity and not a place we expect to be competitive.
Dan, did you want to share some of the work that's being done on comparison tools? I think we've done a lot of analysis about other barriers. Another thing that has come up when we have talked to players, small and big, is that customer acquisition costs are very significant when you're going outside of your bank existing customer base. So the marketing spend just to simply sign someone up is often very expensive. And we often found that in the credit card comparison tools that people go online, which is often a pipeline for people discovering, sometimes it may even have a kind of pay to play dimension to it. So I don't know if you want to share, Dan, just to update everyone.
Yeah, absolutely. Perhaps I'll kind of introduce this as an example. As consumers ourselves, we've all seen both the amount of direct mail, that we get, but also from research, when people go to shop for cards, they might do so online, and then they find these comparison sites that show them the best credit card or allow them to compare But a lot of them, as the director mentioned, they're pay to play, so there's very limited content in there, and particularly cards issued by small banks are usually not featured there. So for prospective customer, they might only have visibility into the largest brands and miss or just not have the opportunity to see cards issued by smaller banks at these comparison sites. Large banks, of course, have the budgets to compete and pay, referral fees in large amounts that perhaps make it limited for other parties. To that end, I also wanted to introduce that the CFPB, we do a survey, it's called a Terms of Credit Card Plan Survey, where we sample institutions across the United States and collect data on the credit cards that they offer, and we make it available on our site. And we're working on an initiative to make it more consumer friendly, so people that are looking for a card have that as a resource and are able to aid their shopping by finding cards that are issued by banks of all sizes, but many of the ones that we have data for are small institutions, from credit unions to community banks, and people can easily compare the terms and can see for themselves where they might have better opportunities looking at community banks and credit unions, or smaller issuers for that matter, where they might have better deals than larger banks.
And just to pivot back to, I think it was something Derek mentioned about assessing third party, including fintech companies and others. I think a area that is often raised with me is whether it's credit card, but it comes up in the context of auto, it comes up in the context of other lending products too. Really, what are the expectations for due diligence around that third party? And, none of you are supervised by us. We, of course, supervise some very large entities. And the expectations that we have of our large entities, of course, around due diligence, it's a little bit of a different dynamic because they tend to be the big player and the service provider is the small player. In many cases, when community banks are looking at partners, it's the reverse, that the third party is actually a much larger enterprise in some cases, has a lot more consumer reach or a lot more overall volume running through their rails. And I think that becomes sometimes a challenge about if something were to go wrong, to what extent would they be highly responsive to you? What types of service level agreements are in place to make sure that occurs? So we are always trying to think about how is it that more of you will be able to have those partnerships, but also can do the due diligence and have the confidence they're going to deliver on it. Because we also take the view you can't just turn a blind eye. You can't outsource and look the other way. You're ultimately responsible for your service providers' interactions with consumers. So I don't know if that has been at all something that has been on people's minds, but I do think that that's a place that we certainly have been thinking a lot about.
I think the the experience we have had with large service providers, whether it's core or it's a credit card or even a call center response, has been we don't have sufficient leverage because we're a tiny player, and they're going to take care of the larger customers first. I mean, there are institutions we know that service multi-billion-dollar banks and us, and the multi-billion-dollar bank gets all the attention and immediate response.
I know there's been movement by the CFPB in terms of regulating consumer reporting agencies. How much movement is there in regulating some of the other players in the space that we work in?
Well, I think it depends. We think of it, the consumer reporting agencies is a huge, huge part of our work. Some of them are very big. Equifax, Experian, TransUnion, FICO, Some are very small. They might be small background report agencies. My sense is that there's never really been those service providers, they're providing material services to you, but they're typically not your agent when it comes to the largest credit reporting companies. So the places that we have focused a lot of our attention on them have really been under their core responsibilities under the law, ensuring accuracy, having appropriate dispute mechanisms, and there's a lot of things related to identity theft and related issues. So we have done some enforcement actions, others for where they have not had robust accuracy dispute. Now, we are also looking at the issue of data brokers, which I think is less about interactions with small banks, but it is a whole tier of background report companies in the digital era that increasingly are collecting information about consumers and often selling it for all sorts of purposes. So that has kind of been more where we're focused on updating the regulations. I'm just trying to make sure I'm fully responsive to your question. On payments, a lot of banks have relationships with some sort of payment provider, or you have no relationship with them but are forced to do business. So in the case of payment apps like Venmo, Cash App, others, you typically don't opt into that. It is just sort of part of they participate through the ACH rules. We of course know that you don't have much leverage with them either, and that's been a big part of what we've been looking at. But I'm just trying to make sure I'm responding, but hopefully I'm getting to your question.
We talked about core providers. We've talked about other third-party service providers, fintechs that do support credit card lending. The payment providers was a great example. Your Venmos, et cetera, PayPal, where they are an entity that should be subject to Reg E. So
They are.
And they are, yes. And so at what point do we start enforcing those regulations on those other entities, your Reg Z? You think about how much impact some of these companies have in not just the servicing of these loans, but also in
Offering.
the document production, like you said, the product offerings online, the comparison shopping, et cetera. So, are they going to be subject to the same
so
expectation?
we would argue that they already are. There are not exemptions for them. It is true, and I don't want to go into too much detail on this. We have, in the past 2 years, I think since I arrived, we've really shifted the supervisory work from bank to non-bank. Not because we think all banks are fine, it's that the number of consumers that are being touched by credit reporting companies, mortgage servicers, non-bank mortgage originators, payments players, I mean, the list kind of goes on and on. I don't have the latest statistics. I want to say over 3/4 or 80% of our monthly complaints is coming just on credit reporting. So the non-bank, non-depository piece of the agency is much bigger, and we have proposed some additional supervision for the payments players in particular. So I think the net result of this is for those players who are credit card, buy now, pay later, I don't want you to think that they are unregulated. But again, they're responsible for a set of laws and regulations. Of course, when they are your agent, it also requires some due diligence in terms of what are they agreeing to provide actual service to you on. And I think this point, Carlos, about being the last in line, this has been the case on not just core service providers, but it's now an issue more throughout the economy. I was hearing that small grocery stores were actually being told from their distributor that there are only certain products. It was the large chains that were going to get the first rights to the inventory during the pandemic. So you would have grocery stores that were sold out of certain things because they there were rights by the large retailers that they would have first dibs on the inventory. Now, as a bank regulator, you then get worried if something goes wrong at one of these these third parties, are they just going to tell their very largest bank clients, we'll get it back in order for you and the rest of you can take a number? I mean, that's kind of the anxiety that we have. And we need to figure out some ways to collectively solve this, because there are opportunities, I think, to leverage the scale of technology where a small bank can actually participate more fully in some of these other consumer credit verticals, but it's also going to require that they are responsive to you and are following all the requirements they have to adhere to.
There's a virtual member that you know from Montana that I want to make sure that he has an opportunity to ask any questions or make any statement. Bruce?
Thanks. Obviously, we don't have any credit cards, so I'm just kind of learning something here. With that, we don't do a lot of consumer lending just because of our demographics and location. But on the commercial side, I had a number of commercial businesses that needed credit cards, like heating and cooling company, you know, with a bunch of techs and rental agencies and stuff. So what we did is we sat down and talked about it, and we set up a debit card. This has been 2-3 years ago, that's tied to a line of credit. And these businesses did not want to mess with a big bank credit card company, you know, if they employee turnover and canceling cards and all this kind of stuff. So we set it up to where the card first looks at the transferring from their main operating checking account. And if there's not funds there, it'll go to the line of credit just to make sure that these employees that need to access, you know, fuel money, parts, whatever, they have access to the funds. And then they can access, the owners can access online banking and, you know, pay the line of credit back down or move funds over to the tech account or something. And it's worked out really well on the commercial side for us.
Well, that's, Bruce, I appreciate that. And I think there's been a few situations where I've heard, and I think I mentioned to you guys, I visited with Bruce at his bank once, and I do feel that if you look at bank balance sheets that are smaller banks, in many ways you are seeing over time an increase in, as you mentioned, real estate and commercial lending exposures. And I do wonder whether, what kind of hope do we have to get more consumer lending back in banks of all sizes? And, you know, the issues in mortgages are quite different. And I think there have been a lot of discussion around this. I think auto is a place where there's also a whole separate, I do want us to keep thinking as a group about what are the ways to, when it comes to credit card or other types of, whether it be a revolving or non-revolving consumer credit, what are going to be ways to scale it? And we're open to, I've shared with many of the banking trades about, could there be different regulatory frameworks for it, for more relationship-oriented consumer lending versus this kind of algorithmic assembly line style? We're really open to it because we see the dollars at stake are very, very big, both for sustainability and growth of community banking and consumer lending, but also for consumers writ large to have lots of different choices. So I think we have to wrap this session. I'll end on, and then I'll turn it back to you, Carlos, on Victor's comment about flying and you know, being pushed a credit card on the flight. I think that we're going to be exploring this in more detail next week. Secretary Buttigieg and I will be hosting a hearing on this airline rewards issues. And I want you to take a look at that because, of course, we are going to be looking at our consumers getting the rewards they're promised. But I think we also have to look at it in terms of you see a few big players having exclusive relationships with banks about being the provider for their points and rewards. There are some jurisdictions where points and rewards aren't locked up with one issuer, that they actually have multiple issuers that are able to offer those points, in many ways making it look more like cash back, which is, if you think about it, anyone can really offer cash back. So I hope that you take a look at that because it does seem consumers are very, very closely watching rewards offerings in order to make decisions on consumer lending. But Carlos, I'll let you close out our first session.
No, thank you very much. This is very interesting. Thanks very much. This is very interesting discussion. I think the whole issue of rewards is one that is anti-competitive to some of the smaller institutions that can offer those kinds of broad programs. So anyway, we'll take a 15-minute break now and we reconvene around 2:15 Eastern time for our next discussion on trends and themes in community banking. Thank you very much all for participating.
So we're going to take a picture.
Yeah. Welcome back, everybody. It was a nice break. We appreciated it. We're now going to shift to the next agenda item on trends and themes in community banking. We are joined by CFPB's subject matter expert, Ann Epstein, Assistant Director, Office of Competition and Innovation, and Amy Circle, Senior Program Manager with the Office of Markets. We are all going to have a good discussion about that. We're going to focus on core service providers. And so I can tell you that from our own perspective, our dependency on core service providers is very significant, and it often involves lack of innovation, costly innovation. Sometimes we want to offer products and they can't because they're not integrated into the core. So it's a significant challenge that the small banks have because we also don't have good leverage in terms of negotiation and in terms of getting them to be responsive to our needs. So let's have some discussions. So Derek, why don't we pick on you, because you have different core needs given that you do banking as a service, but at the same time, that's highly innovative, relatively speaking, and that's where you have your challenge.
Yeah, I mean, when we think about our core provider, so we use a relatively small core provider. It's called COCC, which is kind of local to Connecticut. And they sometimes lag behind in their offerings or capabilities than something like a Fiserv, right? And while we like what they're able to offer us in some of the traditional banking areas, sometimes, ID verification, some of the capabilities they have there have lagged. And that's just core, right? And we have several other vendors that we are reliant upon. And any big vendor relationship is a major consideration to the bank. I think about our AML, transaction monitoring provider, like that is a major software that all banks have to have. And to the extent that for whatever reason it's not meeting what your desires are or needs are, to shift from an AML transaction monitoring service provider is a massive undertaking. Not only is it costly, but there's just so much regulatory pressure on AML that there's a lot of eyes on it from a regulatory standpoint to get that right. So sometimes when we get into a vendor relationship, it's like, okay, this is probably going to be set for at least 5+ years. So every kind of big vendor decision is a bank-wide decision. And there have been instances where on a mortgage servicing portfolio, a trailing residential mortgage that we no longer do, right? Our contract was written many years ago, and our SLAs, being one of the small community banks, for an audit request is 15 business days, which is just not good enough in a lot of ways, right? In an examination request for an FDIC exam, 10 business days. And if there's a question or they don't provide something the right way, we enter the back of the queue again, 10 more business days, right? Which you can only imagine how a regulator feels about those delays. So we are absolutely subject to those. And, as it relates to BaaS, the transaction monitoring is a big piece. The core is a big piece. And what some of the fintechs are trying to do, we have to ensure actually aligns to what the core is capable of. And it's not something that you can just switch easily. I hope that answered your question, Carlos. Thanks for calling on me.
Well, you should know that I had a hand in the software that COCC has. When in my prior life, we started Open Solutions, which is what COCC bought. So it was interesting. We have gotten a separate core, we call it a sidecar, to do digital banking. So you got a retail core and a different core for digital banking. And that is effective because the digital core is much more flexible, much better at integrating things. So anybody else has a comment on your dependency of core providers and maybe how the contracts are structured?
I'll echo what Derek said and what you said initially is we are significantly dependent on our core provider for providing any novel services for customers. We have found that any product offerings that are new are slow in coming and very cost prohibitive. My favorite example currently is a way for us to facilitate real-time payments, whether it be through the clearinghouse or FedNow, is going to cost us around $80,000 a year, which at a bank our size is completely impossible. You know, there's no profit in that and the cost is too significant. So, and, you know, often the response we get is, you know, have you considered a fintech? Well, in a conversation earlier, Derek is a great example of a bank who's embraced fintechs in one particular space, but at the expense of 15% of their staff is dedicated toward risk and compliance in managing that relationship. And again, you have to make a dedicated shift in your business model if that's the route you want to go. So adding a fintech isn't as simple as just bringing on another third party. There's a very high expectation for due diligence on the part of the bank. And we don't have the capacity to manage that unless it's a very established, well-known third party.
Yeah, FedNow. I know that. Anybody else looking at FedNow?
We are, I don't know that we have started, but we are looking at it, but only, I know it's
It's a receiver, only the receiver.
Only the receive, not the send. But in any event, just to follow up on the comments regarding the core, we had for the longest period of time, and I can't remember, maybe 20 years, we were, you know, using one of the big four. And as we thought about our vision for growth and transformation of the bank, especially as we went into the digital environment, to the point that has been made before, the service provider, we were in the, you know, being small, we were always sort of last in line, you know, because, and then basically, we'll get to you when we get to you. And, or you basically take what we're offering. And in order for us to make a change, you know, so in order for us to improve our product offerings and our processes, we just said, okay, we can't do this any longer. So we changed. But it's also a matter of scale and size. It's a point that Derek made, we can't go to somebody that's too small that can't really provide the services that we need. So we need to have somebody that's bigger that can do that, but be more responsive. You know, and basically when we were doing the evaluation of the new core provider, we said, if we want to be agile, flexible, can they turn around our requests in a proper, you know, in a period of time with the type of service quality, or not only the response, but also the product or the process that we're asking them to change? Can they do that in a much more efficient and quicker way? That was the biggest one. And of course, are we going to get nickeled and dimed to death, which, you know, the big guys do? You make a request, it's $15,000, and you know, how many weeks will it take? Because we're low person on the totem pole, we have to do this. So we made the change. We're very happy right now with the change that we made. But changing core providers is not a simple thing because when we learned that the hard way, there are things that the core the system does that we didn't realize that how different it was. And so the learning curve is one that is also fairly, not steep, but something that you need to be very of. And I think that's one of the key parts is when we talk to other institutions like us, make sure that you understand what you're getting yourself into. The benefits are there, but like anything else, there's a price to pay, not only from a time and effort and a commitment, for your people. And a bank like ours, again, we're Bruce has 12 people in his shop. I have 35, and I'm like I mentioned before, we all wear different hats, and we need to have that ability to.
So years ago, there used to be many other service provider data centers and many more different systems that people had. Now we have big four that have maybe 12 systems between all of them and not much other than that. But Ignacio, you still have your own system of the data your holding company has. And I'm curious how that help or hinder your ability to make change to compete and remain flexible.
Well, first of all, it's cheaper. But more than that, we do have a very extensive due diligence in the core provider, which is us. We have added over the years, since I've been with the bank over 40 years, we've had the same system, but we've added speed and capacity and a lot of other stuff. But our main concern is security and the AML type of situation that goes with our own servicing, our own company. But we have at least maybe 25, 30 software companies that provide to the system. And that's where the main game is, the software providers. And of course, the main thing here is, again, I go back to security and the AML systems, but it also requires a lot of us to be involved in it from the very beginning. We have a business team that's attached to any new system that we want to add or adjust or whatever, to make sure that new software is compatible not only to our core, but to the consumer needs. Because there are many times that we bought some software that works maybe for 90% of the issue, but the 10% is a major problem with some of our customers, especially some of our big customers. So before we buy any type of software, those 25, 30 providers that we have, we provide a business person inside the committee that works with that software to make sure that the viewpoint of the consumer, whether it's retail, commercial, or international, or even marketing, are involved in the process of what they're providing to us. And of course, it's expensive because it's most of the time they custom made that software for us. And there's where the cost comes in. But it turns out to be what I've seen over the years. I mean, very appropriate software things that we have in providing the business need and the demand that the customer wants, aside from the security and the AML compliance issues that we have. Now, keeping in mind that at our bank, and I don't know what the last count is, our IT people are very good. We have programmers and engineers in there, but they try to hack into our system at least 50 times to 100 times a day. Every day, they're trying to hack into our system. They haven't gone past first base, but we're very concerned about that for obvious reasons. So we have to make sure that our software is just as strong as our core, systems that we have. So yes, we do have our own core system internally.
And you had a question?
Yeah, it's interesting because there's I think a spread, right? Someone built your own, still on core, core transitions, as well as sort of, as you point out, kind of the side core. And I just want to sort of probe on that a little bit, right? From a perspective of, there has been a lot of consolidation, of course, in the core space, as you know, and have contributed to. But there's also been, I think, or at least what we're seeing, some fragmentation in terms of, additional packages that kind of go alongside. So like a digital presence, to your point. You can see best of breed in a couple of other places. And so what we've seen in some cases that people are, sort of shrinking their core. So instead of getting all of their software needs from one provider, that they're sort of having a little bit more of a best of breed type approach, and then using APIs and other things to kind of connect to the core. And I just wanted to sort of think about, for those of you who did decide to change cores or are thinking about different strategies, whether, you had any thoughts on pros and cons, whether the contracts that you currently have with your core providers create challenges in one or other of those strategies, or just any thoughts you had there.
Well, part of the problem to go to, so to speak, the best of breed approach is that you have to deal with two. One, the technology side, the integration, and second, you have to deal with the legal and the contract. And so what happens is that most core provider contracts have multiple pieces to it, and they're all not necessarily coterminous. So you might have your card servicing contract through the provider end in January of one year, and the actual core ends in February of a different year. And so that's real bad stuff. Secondly, the API approach, it sounds great, but many systems that are flat file, COBOL type based don't have API capabilities. And so you're left with nighttime batches, which are not online, et cetera. So the benefit of both diversification of your providers and the integration are sometimes difficult to achieve and very expensive. We put on top of our core a Salesforce application, and that required a middleware of MuleSoft, and the expense to do that was significant. Now, the beauty is that our staff now works mostly on a Salesforce environment and is core agnostic, but it was millions of dollars and years of implementation.
Yeah, we're in a unique situation because through Beneficial State Bank, because we are going through a transition right now, changing core systems. So we get to a point as a bank that you outgrow your condition where you're at, your asset size, your products, and you need to expand. And so we're going through those growing pains right now because it takes a lot of time just to prepare for the actual day, which are, I think in our mind, everybody's mind right now, I think it's like in August, I think it's 17th. It's ingrained in everybody's mind. That's the day of the actual conversion. So a lot of training across the board, very costly to Carlos's point to be able to make an investment, but it's needed because as we grow, if we're in that trajectory for growth, we need to make sure that we have the tools that are required. And it's not just for marketing and for product delivery, it's also for compliance and regulatory issues. And so we got to make sure that the data is in there that transfers over from the previous core to the current core is done correctly. A lot of testing that's going to be required. And so it's not just, unfortunately, a matter of just switching a switch one day and then everything's going to work. We all know that that's not happen most times. So we have to be prepared for that. But we are looking forward to improvements and enhancements in our workflows, our queries, having a data warehouse where we could store data that is more secure. And so there's also going to allow us to look at enhancing our products. Some of the things we had to hold off intentionally because we weren't able to. For example, our Bank On product, we had developed a Bank On product last year, and because our current core provider was not able to support it, we had to wait for it. And so we've been working on this for a long time, got it approved through our product committee, but yet we can't deploy it until we have our new core system. Also very excited about being able to enhance and expand certain our products like our credit cards I mentioned before, have been limited to just our market, but now we're going to be able to go national with it. Same thing with our small business lending products that we're going to be able to expand. And even there's some tools that we're excited about being able to offer some of the mobile applications in various languages. And especially as a recipient of federal funding, as a CDFI, and also funding through the Department of Treasury, we're obligated also to make sure that we're offering access to products and services in various languages. And so this new application, these new tools are going to allow us to even grow further. So just some of the things that we've been considering.
But speaking of those two things, CAFIs and Treasury funding, and even Section 1071, the reporting requirements are such that the core providers are not really stepping up on that on a timely basis, particularly on something that doesn't impact the whole industry, but segments of the industry. So we actually ended up having to retain a separate provider to do ESIP reporting, which happens to be another core, but they decided to do it. So now the problem is the integration between those two things doesn't exist. So it's all, horrible manual effort. We did want to talk a little bit about trends, obviously not just core providers. So we started to mention FedNow, and Sergio, you said you have same issues about do we go to FedNow and do we just become a receiver, right? But we also, like Ignacio does, deal in the international side of the house, where instant payments has progressed much greater than the United States. And so if you take Brazil, for example, they have instant payments that are that must be offered by every bank and is provided through their central bank. Very effective, very effective. Here we don't. It's not, FedNow is not mandated, and FedNow is not really a panacea and very expensive. So we are ourselves delaying it because it's too expensive, and we think there will be different alternatives to come out and better. So anybody else has looked at this? Yes, go ahead.
I was just gonna say too, and I mean, in the context of FedNow, the other piece that we've noted, and you all, obviously, you're community bankers, you value the relationship with your customers. FedNow is not really a consumer-facing product, so your customers conceptually wouldn't necessarily be able to say, well, let's going to send this via FedNow, please. But in the capacity and the ability for you all to be nimble, agile, strategic, innovative, sort of forward-leaning in the face of market challenges, I think that's sort of the underlying piece around FedNow, and in essence, the piece around the core provider, where they are, you're sort of beholden to them in allowing you to be strategic, to be innovative, to launch new products and services. And to Jennifer's point, the prohibitive costs really force you as banks to say, all right, well, what can we, where can we go forward? Where can we not? And so I guess just sort of at a 60,000 foot level, how do you sort of see this space evolving? And Carlos, you look like wah. Sorry, I don't mean to bring the room down. Sorry.
Well, we'll ask Jennifer where she got the $80,000 cost in FedNow. The problem is that our item processing provider, which is also our core, which also has its own clearing network, it's a little bit against their economic interest to allow us to bypass their clearing network. And so there's no urgency and there's high cost to do that. Jennifer, who's charging you?
It's our core provider. And we also, because of our size, we don't directly engage with our core provider, with the exception of card services. So we actually use a third party to manage that relationship for us. So we get charged twice. So we get charged from the core and from our third party who manages the core. So that $80,000 is, I should be clear, that's a comprehensive installation. We could do it for less if we just did receive. So that would be the full implementation of real-time payments, send, receive, and request for payment. And that includes, and I built into that, the cost, the required cost of fraud monitoring software that we don't currently have to buy due to our size. Like, we're able to manually manage our transactional fraud monitoring currently, but there is a requirement if you go to send on real-time payments that you have to have an actual tool in place. And so there's a cost involved with that as well.
Down?
No, no. There's more data here. So you said the F word, and I'm going to raise that. Fraud. Oh, I know. But fraud, which sort of figures so prominently across the entirety of financial services, let's be candid. And you've talked about risk mitigation and AML and all of that. But are you shifting or being forced to shift or expand on a fraud mitigation strategy as community banks? Because you're all confronting it as well.
So far, we've been able to hold fast. Like I said, we are, I think, one of the few banks that are able to get by with a manual fraud exception manual fraud management process. I'm guessing of all of us in the room, most of you have a monitoring system in place. And we do not. Outside of, we have some debit card fraud monitoring through our card provider, but we don't have a comprehensive solution across our entire platform. And so far, our regulators have been satisfied with our due diligence from a manual standpoint. Now, that being said, with a staff of 50 people in a bank, I have one person who full-time does that. So, you know, the cost trade-off there. But thankfully, we have not. You know, it's been hinted at in exams. You know, have you considered is always the question. And my answer is always, yes, I have considered. I have priced it, and it actually costs more than my full-time employee. So at this point, it doesn't make sense. And we are in a low-risk area, low-risk product offering, you know, our risk profile allows for us to continue doing that. But we expect it won't be long before we are required to up our game in that area.
The problem is, and we run into it, is, yes, you can get the monitoring systems, and we do, but the human has to then take the exception and analyze it and track it down and make a determination whether or not to pay that item, for example. And humans can also make mistakes. The biggest loss we had, it was one of our folks that, you know, said pay the exception. In retrospect, the answer should have been no. But, you know, so we have humans, but the monitoring systems only provide you, you know, the exception that you still need to resolve and look at it. So they don't really, I don't think monitoring systems save you money. They, in fact, depending on the setting, they may in fact give you more work to do.
Yeah, and I agree with that. We went through an examination, a compliance examination here about 4 or 5 months ago, and we did perfectly well. We've done very well over the years. But about 2 or 3 months ago, we installed a new system that was done internally. It was not a software, it was done programmed internally. So now every officer and every salesperson has a dashboard in their computer of their own particular portfolio, let's say. I, as a president, have the whole bank, basically. So as an example, the first thing I do in the morning, I go to my computer and I see
all the large transactions that occurred within the bank. Anything over $1 million, I get to see who went up or who went down $1 million or more. So I see, and I see the officer, and if I see somebody that I don't recognize, then I call that officer and I find out, who's this guy and what's he doing? Well, that particular data was never given to examiners because we have other systems that monitor, like you say, AML kind of stuff, that are inside the system itself. But now each officer now has his own ability to look at his own portfolio. Of course, that dashboard not only gives you the highs and the lows, but the loan portfolio and who paid off and who didn't pay off, the yield, how much fees they've made, all this kind of stuff, because we're trying to make sure that everybody's accountable to what they're doing. But anyway, going back on what I'm trying to say is, so now I get this data. Now, what am I going to do with it? So I see $1 million that went in for somebody that I don't recognize. Now, do I have to, well, I will have to inquire internally who this guy is and what happened and what is he doing, what kind of business he in. But that's between me and the officer. But does that mean that I have to record this in some place so that when the examiners come, I'm going to have to show them this kind of information that before this guy was not in our list of, high-risk customers. Now all of a sudden I say, well, maybe this is a high-risk customer. Maybe he's not. Maybe he's just doing business. So now high technology can backfire on me because now I'm going to have to do more work and create another list and another monitoring system that is already being monitored, and I've been having excellent results with the examinations on AML. So now I'm opening another can of worms for these guys to look at and ask me questions, and I don't want that.
I think we're all in the same boat. We have about 10 minutes left, and one of the other trends that they wanted some discussion on was what's happening in our communities, how they're adjusting to the higher interest rates and on mortgages and consumer loans, and what kind of metrics we have in origination and refinancing trends. Let me answer, so to speak, backwards. In terms of originations, and we are a wonderful family provider. We are CRE lenders and construction lenders and small business lenders. We don't do a lot of consumer, but in 2022, we did around 700 million in originations. In 2023, we did 970 million, almost $1 billion in origination. We expect to be down to the 250 million in 2024. Why? Funding has, been essentially totally diminished. The competition for deposits in our area and even on the internet is so high that we are not getting the funding. Our loan to deposit ratio, I think, Victor, yours is small. We're almost at 130. Our dependency ratio on wholesale funding is at almost 40%. It's quite high, and obviously it's hitting the levels that regulators don't like it. We don't like it. But even though our retail deposits have grown by like 90 million since the end of end of 23, it's not enough to keep pace with the high loan demands. And so it is interesting because loan demand for housing, affordable housing in New York has really increased a lot. 1 to 4 family has not, in fact, has decreased. So our originations and sale in the secondary market has decreased. We're probably doing 20% today of what we did in late 22 before rates started to go up. What we don't see is consumer being squeezed because most of the apartment financing that we do are for affordable housing that have a 5-year repricing. And the affordable housing rent stabilized, generally increase at a faster pace than the rates have increased. Namely, 2 to 3% has been the amount of rent increase annually over the last 3 or 4 years. When you compound that, that's greater than the increase in interest rates. So that side of the house is pretty well. Where we do find some strain is on the old buildings where the rent stabilization rules change so that it's very hard for a landlord to recover an investment and then have the rents cover that investment. So they're small landlords, they're usually small, it's 10 family and less, are getting quite squeezed on the maintenance costs and on the improvement. So on the short term, we don't see a big issue, but there's a complete disincentive to landlords to maintain the place is well fixed. And that does not bode well for it, a longer term. I don't know what kind of experiences you folks have had.
We're facing pretty much the same. In fact, our focus this year and probably into next, because of the continuing level of high interest rates, is a balance sheet restructuring. We are focused on increasing our deposit base to increase the level of liquidity reserves that we have. But and so, we have not frozen our lending operations, but basically maintained or focused our lending operations in residential mortgage lending, because we are very much involved in affordable housing and first-time home buyers. And again, the focus of our activity is the people that can't really afford housing unless we provide them assistance with the down payment assistance program that we have, and higher LTVs and all. So that particular part of the segment, we can make as many loans as we would like in that market. But but then again, part of the constraint or restraint that we have is, can these people afford the rates? And so we need to balance that out. And so we're very cautious about that. But to what Carla said, this balance sheet restructuring the fallout is really the negative impact on profitability. Interest rate deposits, funding costs are much higher, probably 3 times what it was, in early part in 22 and early part of 23. So that's an issue. And then when you reduce your lending activity, if we're in a net interest margin bank, so your top line revenue has gone down. You're increasing your deposit base, your interest costs, your funding costs have gone up. And so, we're caught between a rock and a hard place. And that's part. And then, of course, the issue of productivity and efficiency is very, so community banks, I don't think I'm speaking just, a singular instance or situation. I think a lot of community banks are faced with the same problems. We're having difficulty getting funding sources, both core and the contingency, but also profitability. So thankfully, our capital base is pretty strong, and that helps. But still, it's this year, 24, and probably a good bit of 25 is going to be challenging for banks like ours to to maintain profitability and to continue to fund the mission based on internal or organic profitability.
Bruce was the one that had 105 on loan to value ratios. I remember that. He wasn't Victor, right? Bruce, what do you have a report from there?
Yeah, like I said, a lot of ours is ag and 1 to 4 family construction. We don't sell any loans. We don't participate in the secondary market. But our ag season is just starting. So we have a lot of unused commitments hanging out there that we have to start funding now through the summer. And it's just very difficult to gain new deposits right now with the way the stock market is. People that swore after they lost money last time in the stock market, they swore they'd never go back. Well, now it's making money again, so they're all going back. And I agree, we're having a hard time finding the funding source. We just had a meeting the other day. Are we gonna try and curtail some of this construction lending? I thought the higher rates would fix itself, but it hasn't. The demand is just, the demand's still there. We're, in our particular area, we're very short on housing. And there's a big Air Force Base project coming into town like 30 miles from us, and it's bringing a lot of new workers and employees to Great Falls and good jobs. So it's going to be challenging, I think, to keep it all funded going forward for the next, year or so.
Thank you, Bruce. We are out of time. So let me just say that I think it has been great discussions. We really appreciate the perspectives that each of you have brought forth. We look forward to the next meeting. And let me now turn it over to Kim George with a thank you very much for putting all this together. We appreciate it. It went very smoothly, thanks to your efforts and your team's efforts. So thank you.
No, thank you, Carlos, and thank you to the CBAC members for joining us today and providing such valuable perspectives. Thank you to participating Bureau staff, Amy and Ann, for joining in this session as well. I know Daniel Martinez, he was with the first session, but still everybody's insights were greatly appreciated. And also thank you to the members of the public for attending today's public sessions. I can officially adjourn this meeting. And EMT, if you can disconnect at this time. Thank you.